This is my Porter's value chain analysis for my potential company, Lighthouse Rentals LLC, your guiding light to quality rentals. Porter's talking about Porter's value chain, the inbound logistics, cost of a 30-year fixed mortgage, $150,000 principal with a credit score of 740 plus on a 20% down payment. The number of payments would be 360. Your monthly payment would be $782.47. Total principal paid would be $150,000. The total interest paid on the loan would be $131,689.56. The total paid would be $281,689.56. Home insurance up to $150,000 for a long-term rental. The company I used was Safeco. The amount per year would be $1,625, and that would come out to a monthly amount of $135.41. Taxes for a $150,000 home in North Carolina. The Western North Carolina tax rate sample would be per $100 valuation. The rate would be equal to 1.0094. $150,000, you do that divided by 100, that's 1,500 times 1.0094. That equals 1,514.1 in total taxes. Monthly mortgage, $782.47. The home insurance monthly would be $135.41. Taxes monthly would be $126.18, and management costs monthly would be $108. So the total cost of inbound logistics monthly would be $1,152.06. Total cost of inbound logistics annually would be $13,824.72. Operations, talking about maintenance and miscellaneous. The general rule, if you're renting out a property, would be 1% of the property value per year. So for $150,000 for a home valued at $150,000, you times that by 1%. That's equal to $1,500 divided by 12 months is $125 a month allotted for maintenance and miscellaneous repairs. So account rate for LLC. Minimum of probably 0.5 to 1.5 hours of consultation per year to make sure the taxes were in line with the business would be $75 to $600, just depending on how long and what the rate was with the accountant that you used. But this service hopefully would end up paying for itself because it would be used to depreciate the purchase price of the rental property, which is usually sufficient to turn a small economic profit into a small tax loss. That means expenses exceed income after depreciation is taken into consideration. So passive activity loss rules will limit the loss to exactly $25,000 for landlords, and this service should pay for itself by using the depreciation of the property to offset against taxable profit from actual rent collection. Potential homeowners association fees would be $50 to $200 per month depending on location and subdivision. That's kind of just a very hypothetical because most student rentals probably wouldn't be located in a neighborhood that would require homeowners association fees. Outbound logistics. Every time you would have to re-rent the house out to a new tenant, you would obviously have to change the locks. So locksmiths cost to rekey the home for new tenants. Flat fee would be $60 trip charge just to get them out on the property. Cost per lock would be about $15 per lock. 2 locks would equal $30. Cost per key, $1.50 per key, so 2 keys, $3. Cleaning costs prior to move-in. Hourly rate, we just said $25 an hour times 8 hours, that's equal to $200. That's probably pretty average, could go up or down depending on how dirty or clean the apartment was, what kind of damage was going on there. Lease filing paperwork, printer maintenance, paper, the ink, I just allotted $100 annually to that. As far as doing that in-house, that would be your cost associated there. Marketing and sales, the average marketing cost and allocating 5% of annual revenue would be, your monthly revenue for rent would be for a $150,000 property would be $1,350 times 12. That's $16,200. You do that by 5%. That would mean by that rate, I would be spending $810 annually. Allocated for radio ads, print ads, flyers, signage for marketing of the business. Cost of personal website domain for the business, put that at $150 annually, as well as the maintenance of the website, but I would do that in-house, so I'd simply be paying for the domain name that I decided to use and whatever hosting company I decided to use there. Service, Revenue accrued through rent at a rate of 0.9% of the value of the home would be $150,000 times 0.009. So that would be your monthly revenue, $1,350. Typical rate of property management company is 6 to 8% of the monthly rent. So that would be $1,350 times 8%. That equals $108 per month times 12 months comes out to $1,296. So the revenue accrued, this is just a typical rate for revenue accrued through rent. It'd be 0.9% of the value of the home. Typically is what you use there when pricing the home. Landscaping company expenses, standard mowing service per trip would be $35 times 12 times a year. Say you do it once a month, that'd be $420. Travel expenses, I allotted $200 annual average. Gas use for travel to and from properties, and just standard vehicle maintenance associated with that, oil changes, etc. there. Conclusion, inbound logistics total monthly would be $1,153.06. Annually, that comes out to $13,824.72. The operations would be $125 monthly. That comes out to $1,500 annually. Outbound logistics, you're looking at $393 annually, one-time cost, based on a 12-month lease agreement. So you're thinking that your turnover of your product is only going to be one time per year. Marketing, $67.50 monthly. That comes out to $810 annually. And the service would be $159 monthly, $1,916 annually. So you're looking at a monthly total of $1,897.56 and an annual total of $22,770.72 for all the business processes associated in the value chain analysis here. So improvements, after looking at the Porter's value chain, we could opt for a 40-year fixed mortgage at 3.77% and a 20% down payment, and that would lower the monthly mortgage payment from $782.47 to $484.50. This would lower expenses by $297.97 monthly and $3,575.64 annually. Operations, instead of budgeting in-home for miscellaneous management, we could potentially opt for a full-service management company that would cover all operating expenses within the business. This would cost the company an estimated cost of $1,296 per year, and this would save the company $204 annually instead of using the self-estimated rate of 1% of the property value per year. So you do that with the equation: $150,000 times 1% equals $1,500 divided by 12. That equals to $125 a month. Outbound logistics, rekeying the locks and cleaning the house prior to move-in could be handled in-house by ownership. This would save the company an estimated $293 annually. So we could clean up the value chain there with the outbound logistics. The marketing, initially the need for a large allocation of capital for marketing would not be cost effective to generate business. And I said this because use of resources online like Craigslist, Pad Mapper, the local classified and want ads would be sufficient to reach potential tenants in a timely manner. This would save the business $810 annually instead of using the 5% rate of profit to reallocate towards marketing. So if we did that in-house, Craigslist, Pad Mapper, relatively cheap, really little or no cost associated there with that. So service, ownership can handle landscaping duties for the property in-house. This will save the company an estimated $420 annually. So, after an analysis of the business's value chain processes, with recommended amendments, the business would save $5,302 annually. This would lower operating expenses from $22,770.72 to $17,468.72 annually. Company revenue accrued through rent at a rate of 0.9% of the value of the property for a $150,000 property at 0.9%. That would be $1,350 monthly. That was what we used initially. That would come out to $16,200 annually. But you would think with such a high demand for student rentals and a relatively low supply of options, a company would be able to value rent at a rate of 1.25% of the principal value of the property. So this would increase revenue from $16,200 annually to $22,500 annually. This would allow the company to maintain a gross profit of $5,031.28 annually prior to income taxes, while actively creating the liquid capital asset through ownership of the property. So you're going to make a profit of $5,000, basically $5,000, $5,031.28 annually prior to income taxes, while you're actually building an asset through purchasing the home. So you take the rest of that money and based on a conservative slow growth strategy, ownership would recycle and reinvest that amount of profit after taxes towards acquiring additional properties. So the Porter's value chain, after looking at it, there's a lot that you can do to save money by handling most things in-house, and obviously opting for a 40-year mortgage. That saves a huge chunk of money there. The marketing and the service there. The marketing for a small mom and pop business early on would not really need to be a sufficient amount of spending. It's fairly easy to get houses rented in a student rental market without that. In the service, obviously most of that could be handled in-house. With ownership living locally, the landscaping and some of the maintenance on the house would be able to be handled by ownership without having to hire an outside source there. So that's my Porter's value chain analysis for my potential company, Lighthouse Rentals, LLC. Thank you for listening.